Hey everyone, welcome back to another dividend investing video. This week, shares of Johnson & Johnson jumped over 7%, announcing beats on both earnings per share and revenue. In addition, we investors learned more about J&J's plans to spin off its ownership in Kenvue, ticker KVUE, its consumer health products division. At the time of publishing, J&J maintains near a 90% stake in that company, but plans to divest its stake in the near future. This seemed like a good chance to take a fresh look at J&J, one of the top dividend stocks of all time, and try to figure out how investors will be affected by this Kenvue spinoff. It does look like investors are going to have a choice to make here, and we will look at Kenvue and see if that might be worth buying and holding on its own. Also, I'll do a quick valuation on J&J stock and see if the valuation system rates it a buy or not after this recent run-up. So let's get into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Today's video was made at the request of one of our subscribers, Lionstar2222. He made the first comment in our recent video about AT&T and Verizon and wanted me to take a look at the J&J and Kenvue situation, and I thought that was an excellent idea. Folks, we just also crossed the 17,000 subscriber mark. I can't thank you all enough for the support. I'm working on getting this to 20,000 subs. Hopefully we can get there before fall comes. And if you aren't subscribed yet, please do so. And if you have, thank you. Look, we have viewers from all over the globe, and I appreciate every single one of you. Now, we looked at J&J back in March. Shares had taken a dive. The stock was trading near its 52-week low of $150. There were a ton of questions swirling around J&J from its pending litigation concerns and the spinoff of its consumer health business, Kenvue. I determined that at that moment was a great potential opportunity to be buying Kenvue if you were okay with the risks of the Talc litigation and what could come from the separation of Kenvue. 4 months later, how are things looking? Well, a few things are standing out to me. First, J&J is trading a good bit higher now at $170.19. The stock is up about 16% from those lows, but the stock is still down 4.5% year to date. Now, J&J did report earnings on July 20th. Both J&J and Kenvue beat analysts' expectations and adjusted full-year guidance. And it's important to note that the healthcare sector looks to J&J as somewhat of a barometer of the broader healthcare industry. So the next thing that stood out to me was back in April, J&J announced its 60th consecutive dividend raise, coming in at 5.3%, which is pretty close to its 5-year average growth rate. Not a lot of companies can boast this type of track record. It is simply phenomenal. Now, another thing is that Kenvue has been trading. It IPO'd on April 4th as ticker KVUE. Its first trading day closed at $26.90, and today it's trading at $24.01. So shares are down about 10% in those last couple months. Kenvue. Now, Kenvue declared its initial quarterly cash dividend of 20 cents with the next dividend date of August 25th. The first cash dividend will be paid out on September 7th, maintaining the same dividend schedule as Johnson & Johnson. This gives Kenvue an annual payout of 80 cents per share, putting shares at a forward yield of 3.33%. Now, there's not a whole lot more to go on yet. Simply Safe Dividends has not yet assigned Kenvue a safety score. We don't know what plans are for dividend growth going forward, so still a lot is unknown, but good to see the company is starting to pay a dividend. This is trading in now part of the consumer staples sector, not the healthcare sector where J&J trades. This makes them more of a Procter & Gamble or Kimberly-Clark type company. Those are pretty decent comparisons. Here are the products and brands that I'm talking about. Tylenol perhaps being the best known. Lots of over-the-counter medications. You got Nicorette nicotine gum. I just discovered they were part of Kenvue. Household brand name lotions like Neutrogena and Lubriderm and Aveeno. And the very popular Band-Aid. In fact, I'd argue the word Band-Aid here in America, at least, is more widely used than bandage. So that's some real brand power with Kenvue. And what remains with Johnson & Johnson will be its larger pharmaceutical and medical device products businesses. And it will remain one of the top 2 largest healthcare companies on the market, along with United Health Group, ticker UNH. They sort of take turns at being the largest. Right now, UNH is a little bigger. So let's get to how the J&J and Kenvue separation is going to go down. Right now, J&J maintains a 91% stake in the company, but will be reducing its stake via an exchange offer that's going to launch in the coming days, apparently, as announced by CFO Joseph Wolk on their earnings call on July 20th. This process is going to allow us, the investors, to exchange all or a portion of your shares of J&J for Kenvue. We don't know much more than that at this point. So this puts an interesting dilemma to many of us who hold J&J. Do we just maintain ownership in the pharmaceutical and medical device business, or do we put it all in the healthcare products spinoff? Or do we exchange a portion of these shares? I can't recommend what is best for your own situation, right? But one thing you could do is look at your exposure in healthcare versus your exposure to consumer goods. Are you heavy on like Procter & Gamble or a Kimberly-Clark? Then maybe converting everything to Kenvue isn't your best bet. Now, I'll probably opt to leave my investment in the J&J business. I'm still weighing the options. I've not bought any Kenvue on its own, but there's no denying the brand power in that company. I would like to end up owning some shares of Kenvue at some point. So we'll see what happens there. That's really what we know about the spin-off/split offer/exchange offer. I'll say that this was an unexpected turn of events. I thought we would simply have a portion of our shares converted over to Kenvue, but they're giving us the chance to make an informed decision. And remember, that's what might be best for one investor may not be the best for your own situation. Now, the other concern that has been hanging over J&J over this last year is their Talc litigation. And there's been some movement on that front as well. Back in April, J&J reached a deal, an $8.9 billion settlement with the lawyers of the plaintiffs. This would be paid out over a period of 25 years. And it's not seen as any impediment on that J&J dividend, and it still needs to be approved by the bankruptcy court. More recently, I found out that they have filed a lawsuit against 3 of the doctors who published studies citing links between their personal care products and cancer. So I'll be following this as well. I don't think any of this litigation going on would be a barrier to investing in J&J or Kenvue. Simply Safe Dividends rates J&J with a score of 99. And remember, we're talking about one of 2 companies to hold a AAA credit rating greater than that of the U.S. government. By the way, the other company I'm talking about is Microsoft. But with shares on the rise, is J&J still a buy right now in my book? Now, to be honest with you, I think J&J is almost always a buy for a dividend investor. There are moments where it's better than others. Now, back in March was definitely a more opportune time, right? But let's get out my valuation spreadsheet and see what it says. On this spreadsheet, I take the average of 6 different valuation models. Because no one individual model is perfect. They all have their flaws, so I average them, and that gives me my own estimated fair value. I can then apply a margin of safety to determine a good buy price. And a company like J&J does not really require that much margin of safety as far as I'm concerned. So here I have the ticker, J&J, share price $170.19, annual dividend of $2.76, putting shares at a 2.8% yield. We have a forward PE of 15.7, forward earnings per share of $10.90. The first valuation I use is Graham's revised valuation. The 20-year yield on corporate bonds right now is at 4.65%. And I'm going to use an estimated growth rate of 4.2%. I got that from Yahoo Finance. This gives us an estimated fair value of $115.52 per share. And look, in this era of high rates, almost every company is going to come out low on this valuation. 18 months ago, we had a 2.65% AAA corporate bond yield. And look how that affects the valuation. So that's something to keep in mind here with this one. Okay, so let's move along to a dividend discount model valuation. Gordon Growth Model is also known by. Going to assume it's going to continue at a 6% growth rate and that we have a 9% discount rate. This gives an estimate fair value of $168.19, very close to current price. For my discounted cash flow valuation, I have a free cash flow at $23 billion, and growing at a rate of 6% over the next 5 years, with a perpetual growth rate of 3% and a discount rate of 9%, giving me an estimated fair value of $170.33. That's just about right at the current price. That's pretty crazy. Now, a couple relative valuations here I like to use. The first is a dividend yield theory valuation. It's simple. It says, what would Johnson & Johnson be trading at if it was at its historical 5-year yield? The 5-year yield is 2.65%, which would make shares of Johnson & Johnson priced at $179.62, a little undervalued on dividend yield theory. And also, we have a PE mean reversion valuation, which would make J&J trading, which says what would J&J be trading at if its PE was at its 5-year historical average, which is 16.6. It would be trading at $180.94 at that case, so we're still a little undervalued here on the PE mean. The last item I like to factor in is the average analyst price target. That's $181.55. So taking the average of these, I have an estimated fair value of Johnson & Johnson at $166.02. This is about 2.5% below where shares sit today, so it just crossed my fair value just the other day. I don't consider this to be an undervalued stock, and I also don't consider it overvalued. If I were to apply a 10% margin of safety, this gives me a buy price of around $150, which is where it was trading back in March, which is when I was recommending it as a buy. Much better opportunity back then. That's when I would be adding to my own position, about that level. But if you're buying J&J at these levels, much respect. There's nothing wrong with that in my book. I hope this has been helpful, but remember, these are just estimations. I could be off on something here, my spreadsheet, or I could have a bad calculation, so always take this stuff for what it's worth. I want to know down in the comments, please, if you're a J&J shareholder, will you be exchanging for any shares of Kenvue, or you've been buying Kenvue yourself? Could be a good dividend payer for many years to come. I'll keep you all in the loop as always. If you're curious about what's been going on with those high-yield telecom stocks, AT&T and Verizon, I invite you to click into this next video. I share my L's freely with you guys, so it's in there. Dividend investing does carry risk, but stick with it over time. Make wise decisions. You will win more than you will lose. Thanks again, everyone, and until next time, keep investing.